There is a sound that every trader who has truly failed comes to know. It's not a loud explosion. It's a quiet, hollow click. It's the sound of a platform logging you out after a margin call. It's the sound of your balance hitting zero. It's the sound of silence that follows a catastrophic loss, a silence so profound and so heavy that it feels like the air has been sucked out of the room. I remember my day with perfect, painful clarity. I was young, I was arrogant, and I had just discovered a small biotech company that was, in my completely unqualified opinion, about to change the world. It was my sure thing. The story was perfect. They had a promising drug in late-stage trials, the community forums were buzzing with true believers, and the chart was coiling, just waiting to explode higher. I didn't just have a thesis. I had a conviction so pure and so powerful it felt like a religious calling. I saw not just a winning trade, but the trade that would define me, the one that would catapult me from a struggling amateur to a trading prodigy. And so I did what every amateur does when they fall in love with a story. I abandoned all logic. The concept of risk management was a boring academic footnote in the epic story I was writing in my head. Position sizing, my position size was all in. A stop loss, I reasoned, was for traders who lacked conviction. It was a tool for doubters, and I was a true believer. I took every single dollar I had in my modest trading account and I poured it into this one stock. For a few days, I was a genius. The stock ticked up a little and the feeling was electric. It was a surge of pure, uncut euphoria, a validation of my superior intellect. I was already spending the profits in my head, imagining the life I was about to unlock. Then the news came. It dropped before the market opened, an email from the FDA. The trial results were not what was expected. The drug had failed. The announcement was a sterile corporate formality that detonated with the force of a nuclear bomb in the center of my life. I watched, paralyzed, as the stock opened not down 10% or 20% but 90%. My entire account, every dollar I had saved and scraped together, was vaporized in the space of a single second. I was left with pennies. I stared at the screen, unable to process the number. And then came the click, the quiet, hollow, final click of the margin call. That day I didn't just lose money. I lost my arrogance. I lost my belief in sure things. I lost the illusion that trading was a game of finding winners. In the silent, humbling aftermath of that failure, I was forced to confront the real truth. I hadn't been defeated by a bad news event. I hadn't been defeated by the market. I had been executed by my own stupidity. I had failed to do the single most important job a trader has. It's not finding the next great stock. It's not predicting the future. The single most important job of any market participant, from the newest retail trader to the legendary hedge fund manager, is the job of managing risk. It is the boring, unglamorous, and absolutely essential art of staying alive. Today, we are not going to talk about how to get rich. We are going to talk about how not to go broke, because only by mastering the art of survival do you ever earn the right to succeed. This is a masterclass in the unbreakable rules of risk. This is the trading thesis. Chapter 1: The Great Misconception, Offense versus Defense. In the grand theater of professional sports, the narrative we are sold is almost always one of offensive brilliance. We are mesmerized by the quarterback who throws the daring 50-yard touchdown pass, a perfect spiral that dissects the defense with surgical precision. We celebrate the striker who scores the magnificent, acrobatic bicycle kick, a moment of pure improvisational genius. We idolize the basketball player who drains a contested fadeaway three-pointer as the final buzzer sounds, a heroic act that snatches victory from the jaws of defeat. Offense is glamorous, it is exciting, it is what sells tickets and makes the highlight reels. Defense, by contrast, is often seen as the gritty, thankless, and unglamorous side of the game. It's the hard-nosed, methodical work of the offensive lineman holding his block, the midfielder tirelessly tracking back, the center patiently protecting the rim. It doesn't always produce a spectacular, shareable moment, but as every great coach, from Vince Lombardi to Phil Jackson, has attested, defense is what truly and consistently wins championships. This same dynamic, this same fundamental philosophical divide between flashy offense and disciplined defense, plays out every single day in the global financial markets. And it represents the single greatest chasm between the 99% of aspiring traders who ultimately fail and the elite 1% who build lasting, generational success. The amateur trader, drawn in by the promise of fast wealth and intellectual conquest, is utterly and completely obsessed with offense. Their entire focus, their entire reason for participating in the market, is to find that perfect entry, to catch that one explosive, parabolic move, to score that single, life-changing trade that will make them rich. Their conversations, their forum posts, and their search histories are filled with exclusively offensive questions. What's the next hot stock? Is this a good time to buy Bitcoin? Do you think this stock can double? What's the best indicator for predicting reversals? They will spend thousands of hours and a small fortune searching for a holy grail offensive strategy. They will cycle through magical indicators, from esoteric moving averages to complex oscillators. They will hunt for secret chart patterns with exotic names, and they will even pay for black box algorithms that promise to predict the market's next move with uncanny accuracy. Their entire mental and financial capital is directed toward the singular goal of making money. This offensive-first mindset feels natural. It feels intuitive. It is, after all, why we are all drawn to the market in the first place. It is also the primary, fundamental reason why most traders are destined to fail, often spectacularly. The professional trader, the one who has survived the gauntlet of multiple market cycles and has the psychological and financial scars to prove it, understands a truth that is completely counterintuitive to the beginner. The professional knows that trading is not a game of offense. It is, first and foremost, a game of relentless, paranoid, and brilliantly executed defense. The professional's primary obsession, the thought that occupies the majority of their mental bandwidth, is not on how much money they can possibly make on a winning trade, but on how little they can possibly lose on a losing trade. Their days are consumed not with the hunt for heroic predictions, but with the meticulous, disciplined, and unwavering management of risk. They operate from a place of deep intellectual humility, fully accepting that they cannot control the market. They cannot control whether a perfectly analyzed trade will ultimately be a winner or a loser. The market is a chaotic, complex adaptive system that will do what it will do. The only things a trader can truly, 100% control are where they choose to enter a trade, where they choose to exit if they are proven wrong, and, most critically, how much of their precious capital they will lose when they are inevitably proven wrong. And it is in the absolute mastery of these three controllable variables that the entire game of trading is won or lost. Let's frame this with a more powerful analogy. Think of your trading account not just as money, but as a medieval fortress. It is your kingdom, your livelihood, the base from which you operate. Your offensive strategy, your system for identifying potentially profitable trades, is the army housed within that fortress. The amateur trader, the offensive-minded player, spends all their time and resources trying to recruit a bigger, more powerful, more technologically advanced army. They believe that if their army is strong enough, if their indicators are sharp enough, they can conquer any enemy and sack any city. The professional, however, the defensive-minded engineer, knows that the strength of the army inside the walls is utterly irrelevant if the walls themselves are weak. The professional spends 90% of their time acting as the chief architect and engineer of their fortress. They are obsessively inspecting the walls for cracks, reinforcing the main gates, digging deeper moats, and planning emergency escape routes. They are paranoid about the structural integrity of their defense. They know from painful past experience that a single unforeseen attack, a black swan event, a surprise announcement, a flash crash can breach a weak wall in an instant and allow the enemy to pour in, wiping out even the most powerful and sophisticated army. Your risk management protocol is the wall of your fortress. Your stop loss is the unbreakable main gate. Your position sizing methodology is the depth and width of the moat surrounding your castle. Without a defense so robust and so well planned that it can withstand any conceivable attack, all of your offensive efforts are ultimately a pointless and dangerous exercise in vanity. Your primary job is not to be a brilliant general leading a heroic charge into enemy territory. Your primary job is to be a paranoid, obsessive, and brilliant military engineer, dedicated to the singular goal of ensuring the absolute survival of your fortress. This philosophical shift, this evolution from an offensive player to a defensive one, is the most significant and difficult psychological leap a trader will ever make. It is the moment you stop seeing the market as a get-rich-quick slot machine and start treating it as a professional, risk-centric business. When you are fixated on offense, your emotional state is inextricably linked to the uncontrollable outcome of every trade. A winning trade delivers a powerful jolt of euphoria and a dangerous feeling of genius. A losing trade brings a wave of despair and a painful feeling of stupidity. This emotional roller coaster is mentally exhausting and creates the perfect breeding ground for the cognitive biases to flourish. You are, in essence, a gambler, riding the unpredictable waves of luck and feeling every single one. But when you commit to becoming a defensive-first trader, your entire emotional landscape begins to change. Your primary focus shifts away from the chaotic outcome of a trade and onto the serene quality of your process. A trade that hits your predefined, mechanically executed stop-loss is no longer a losing trade in the emotional sense. If you followed your plan, if you adhered to your risk parameters, it was a successful execution of a necessary business expense. It was a small, calculated, and unemotional cost incurred in the process of seeking outsized opportunity. There is no emotional sting, no damage to your ego. Conversely, a winning trade is not a cause for wild celebration or a confirmation of your genius. It is simply the quiet validation that your defensive fortress allowed you to stay in the game long enough for your statistical edge to manifest. You become emotionally detached from the short-term noise of individual wins and losses, and anchored to the long-term execution of your defensive system. This is the great secret that separates the 1% from the rest. The reason professional traders appear so disciplined and unemotional is not because they are somehow born with more willpower or are less susceptible to fear and greed. It is because their entire operational framework is specifically designed to make emotion irrelevant. Their unwavering, obsessive focus on defense, on the meticulous management of every variable that is within their control, gives them a sense of calm, confidence, and professionalism that the amateur, whose hopes and fears are tied to the uncontrollable outcome of a trade, can never hope to achieve. They are not trying to predict the future. They are simply managing probabilities and protecting their capital with a ferocity that the beginner reserves only for trying to find winners. Before we can learn the specific tactics of how to build the walls of this fortress, you must first accept this core philosophy deep in your bones. You are not in the business of making money. You are in the business of managing risk. The profits you will find are simply the natural byproduct of doing that job exceptionally well. Chapter 2: The Cornerstone, the 1% Rule. In every profession, from aviation to surgery, there are core principles and checklists that are so fundamental, so absolutely critical to survival and success, that they are considered non-negotiable. For a pilot, it's the pre-flight check. For a surgeon, it's the sterile field. These are not mere suggestions, they are the bedrock upon which all other skills are built. In the world of professional trading, we have our own core principle. It is the central, load-bearing pillar of the entire defensive fortress. It is the single, simple, and elegant rule that separates the professional who weathers any storm from the amateur who is washed away by the first tidal wave. This is the rule that the top 1% of traders live and die by. It is the rule that, once you fully understand its profound implications, will change the way you look at the market forever. The rule is this: you shall never, under any circumstances, risk more than 1% of your total trading capital on any single trade idea. Let's be crystal clear about what this means. If you have a trading account with $10,000, you are not permitted to lose more than $100 on any one trade. If you have a $5,000 account, your maximum acceptable loss per trade is $50. If you have a $100,000 account, your maximum loss is $1,000. This is not a guideline. It is not a suggestion to be considered. It is an unbreakable law. It is the cornerstone upon which your entire trading career must be built. To the beginner, this rule often sounds absurdly restrictive. Their offensive-minded brain screams in protest. How can I possibly get rich risking so little? If I risk only $100, even if the stock doubles, I only make a small profit. I need to risk more to win more. This line of thinking is the siren song of financial ruin. The 1% rule is not designed to make you rich on one trade. It is designed to do something far more important, to guarantee your survival. The first and most powerful function of this rule is that it makes you mathematically indestructible. The single biggest threat to a trader is not a bad strategy, it's the risk of ruin. This is a statistical concept that defines the probability that you will lose your entire account and be forced out of the game. The amateur, who might risk 10 or 20% of their account on a single high-conviction trade, is always just a few bad trades away from total annihilation. A string of just 5 consecutive losses at 20% risk would wipe them out completely. A streak of 5 losses is not a rare event. It is a statistical certainty that will happen to every single trader at some point. The amateur is playing a game of Russian roulette with their capital. Now consider the trader who strictly adheres to the 1% rule. Let's imagine the absolute worst-case scenario, a catastrophic, confidence-shattering losing streak of 20 consecutive trades. For the amateur risking 10%, they would have been wiped out long ago. For our 1% trader, after 20 straight losses, their $10,000 account would be down to approximately $8,179. They have lost nearly 20% of their capital, which is painful, but they are still completely in the game. They have survived a storm that would have destroyed almost everyone else. They have enough capital to continue executing their strategy, to wait for the probabilities to normalize, and to recover their losses. The 1% rule is your mathematical shield. It ensures that no single trade and no statistically normal string of losing trades can ever knock you out of the business. It guarantees your longevity. The second, and perhaps even more profound, function of the 1% rule is psychological. It is the ultimate antidote to the emotional hijackings of System 1. As we've established, biases like loss aversion are triggered by the psychological pain of losing money. The beauty of the 1% rule is that it keeps the pain of any single loss so small that it barely registers on an emotional level. When you know, with absolute certainty, that the maximum amount of money you can possibly lose on the trade you are about to enter is a mere 1% of your capital, an amount that will have no meaningful impact on your life or your future trading prospects. The trade becomes emotionally insignificant. Think about it. Can you get emotional about losing $100 from a $10,000 account? It might be annoying, but it's not going to cause you to panic. It won't make you engage in desperate, irrational behavior like moving your stop loss or revenge trading. The emotional stakes are simply too low. The 1% rule defangs the market. It transforms each trade from a high-stakes, nerve-wracking battle for survival into a calm, dispassionate, and almost boring business transaction. It allows you to operate from a place of cognitive ease, where your rational system too can remain firmly in control, executing your plan without being deafened by the emotional screams of your System 1. You stop trading your profit and loss statement and start trading your system. This emotional detachment is not a personality trait. It is a direct, engineered consequence of a disciplined risk management framework. Furthermore, adhering to this rule forces you into a professional mindset of consistency. When you risk a random amount on every trade, sometimes 5%, sometimes 2%, sometimes 10%, your results become meaningless. You have no way of knowing if your profits are a result of a good system or just a result of getting lucky on a few oversized bets. Your performance data is hopelessly skewed and polluted. But when you risk exactly 1% on every single trade, you create a perfect, laboratory-like environment for testing your strategy. You have standardized the variable of risk, which means your long-term results will be a pure reflection of the statistical edge, or lack thereof, in your system. It allows you to honestly assess whether your strategy is viable over the long run. This rule is the great equalizer. It doesn't matter if you have the most brilliant trading thesis in the world. It doesn't matter if you've discovered a revolutionary new indicator. If you do not adhere to a strict, fixed-risk model like the 1% rule, you will eventually fail. A trader with a mediocre strategy but world-class risk management will always, over the long term, outperform a trader with a brilliant strategy but sloppy risk management. Why? Because the trader with world-class risk management will still be in the game to trade another day, long after the brilliant but reckless trader has blown up their account. Longevity is the hidden secret to profitability. The 1% rule is the key to that longevity. It is the simple, elegant, and unbreakable cornerstone that holds the entire fortress of professional trading together. Chapter 3: The Holy Trinity Risk/Reward, Win Rate, and Expectancy. Adopting the 1% rule is the single most important step you can take to becoming a professional trader. It is the rule that guarantees your survival. But survival alone is not the goal. The ultimate goal is to thrive, to be consistently profitable over the long run. The 1% rule is the shield, but a shield is useless without a sword. In trading, your sword is your edge, and that edge is not a magical indicator or a secret pattern. It is a simple, cold, hard mathematical reality. This reality is governed by what I call the Holy Trinity of trading mathematics. Three interconnected variables that, together, determine the long-term profitability, or lack thereof, of any trading system. Those three variables are your win rate, your risk-to-reward ratio, and the ultimate synthesis of the two, your expectancy. Understanding the interplay between these three concepts is what elevates a trader from being a blind rule follower to a true risk manager who understands the engine of their own profitability. It is the language of professionals. and mastering it is non-negotiable. Let's start with the first and most seductive metric, win rate. This is simply the percentage of your trades that are winners. If you make 100 trades and 60 of them are profitable, you have a 60% win rate. For the amateur mind, this is the only metric that seems to matter. It's a vanity metric, an easy-to-understand school report card. A high win rate feels good. It strokes the ego and satisfies our deep-seated need to be right. This is why so many new traders are drawn to strategies that produce a high frequency of small wins, like scalping for a few ticks of profit. They might win on 8 out of 10 trades, giving them a glorious 80% win rate. They feel like a genius. But as we saw with the disposition effect, a high win rate in and of itself is utterly meaningless and can often be a direct path to ruin if not balanced by the second, more important element of our trinity. That second element is the risk-to-reward ratio, often abbreviated as R/R. This is a measure of how much your average winning trade makes compared to how much your average losing trade loses. If your system has an average loss of $100, your 1R risk unit, and an average profit of $300, you have a 1-to-3 risk-to-reward ratio. This is the part of the equation that the amateur almost always ignores. The scalper with the 80% win rate might feel great, but if their average win is only $20, and their average loss, on the rare occasions they let one get away from them, is $200, their risk-to-reward is a disastrous 1-to-10 on average. They are picking up pennies in front of a steamroller. Conversely, a professional trend-following trader might have a very low win rate, perhaps only 30 or 40%. They are wrong more often than they are right, something the ego-driven amateur would find intolerable. However, their system is designed to catch large, outsized moves. Their average loss might be $1,000, but their average win might be $5,000, giving them a powerful 1-to-5 risk-to-reward ratio. They endure a series of small, manageable paper-cut losses, knowing that a single one of their winning trades will pay for all the small losses and then some. This demonstrates a critical truth. You do not need to be right often to make a great deal of money in trading. You just need to ensure that when you are right, you are very, very right, and when you are wrong, you are only a little bit wrong. This brings us to the third and most sacred element of our trinity, the concept that binds the other two together into a single, actionable number: expectancy. Expectancy is the mathematical formula that tells you what you can expect to make, on average, for every dollar you risk over a large series of trades. It is the true measure of a trading system's profitability and viability. It strips away all ego, all emotion, and all storytelling, and it reveals the cold, hard mathematical edge of your system. If your expectancy is positive, you have a winning system that should be traded. If it is negative, you have a losing system that will inevitably drain your account, no matter how good it feels in the short term. The formula for expectancy is straightforward. Win rate % multiplied by average win size minus loss rate % multiplied by average loss size equals expectancy. Let's apply this to our two traders from before. First, our high win rate scalper. His win rate is 80% and his loss rate is 20%. His average win is $20 and his average loss is $200. 0.80 multiplied by $20 minus 0.20 multiplied by $200 equals $16 minus $40, which equals negative $24. This trader's expectancy is negative $24. This means that for every single trade he takes, on average, he is statistically guaranteed to lose $24 over the long run. His high win rate is a deceptive illusion, a psychological anesthetic that masks the terminal cancer in his methodology. Now let's look at our professional trend follower. Her win rate is a modest 40%, meaning her loss rate is 60%. Her average win is $5,000 and her average loss is $1,000. 0.40 multiplied by $5,000 minus 0.60 multiplied by $1,000 equals $2,000 minus $600, which equals positive $1,400. Her expectancy is a massively positive $1,400 per trade. Even though she loses on 60% of her trades, every time she puts on a position, the laws of mathematics state that she can expect to earn an average of $1,400. Who would you rather be? The trader who feels right 80% of the time but is going broke, or the trader who feels wrong 60% of the time but is building a fortune? This holy trinity, Win rate, risk-reward ratio, and expectancy is the dashboard for your entire trading business. You must be tracking these numbers with religious devotion in your trading journal over a large sample of trades, at least 100 or more. Understanding your own numbers is liberating. It allows you to tailor a strategy to your own psychology. If you find you cannot mentally handle a low win rate, you can design a system with a higher win rate. But you now know that to be profitable, you absolutely must ensure your average risk-reward is strong enough to create a positive expectancy. If you are comfortable with frequent small losses in the hunt for huge winners, you can build a low win rate, high risk reward system. The key is that you are no longer guessing. You are no longer trading based on feelings or ego. You are operating like a true professional, a quantitative risk manager who understands the mathematics of their own edge. The 1% rule protects your capital. The Holy Trinity tells you how to grow it. Together, they form an unbreakable partnership. The shield of the 1% rule gives you the longevity to stay in the game, and the sword of positive expectancy, forged from a disciplined balance of your win rate and your risk-to-reward ratio, is what allows you to win that game over the long run. Chapter 4, The Art of the Stop Loss, Your Invalidation Point. We have established the unbreakable 1% rule as the cornerstone of our defense, and we have explored the holy trinity of mathematics that governs our profitability. Now, we must translate these high-level strategic concepts into a concrete tactical action. We must answer the most practical question a trader faces on every single trade: where precisely do I get out if I am wrong? This is the art and science of placing a stop loss. For the amateur, the stop loss is an afterthought, a source of frustration, and an emotional pain point. They see it as the mechanism that forces them to realize a loss. For the professional, the stop loss is a thing of beauty. It is an instrument of precision, a tool of liberation, and the ultimate expression of a well-defined trading plan. The professional does not view the stop loss as a pain point, but as something far more powerful, the logical invalidation point of their trade thesis. This reframing is a critical psychological shift. When you enter a trade, you are not merely gambling on a direction, you are putting forth a specific, testable hypothesis. For example, your hypothesis might be, I believe this stock, which has been in an uptrend, has pulled back to a key support level and will now resume its upward trajectory because buyers have previously shown strong interest at this price. This is a clear, logical thesis. Your stop loss, therefore, should not be placed at an arbitrary price based on how much money you are willing to lose. It must be placed at the specific price level that definitively proves your hypothesis is wrong. In our example, the logical place for the stop loss would be just below that key support level. Why? Because if the price breaks cleanly through that level, it is a clear signal that the buyers you were counting on have failed to show up, and your entire reason for entering the trade has been invalidated. When your stop loss is hit, it should not be an emotional event. It should be a simple information-gathering event. The market has just provided you with a definitive piece of data. Your thesis was incorrect. That's it. You accept the data, you take your small, predefined loss as the cost of acquiring that information, and you move on to the next opportunity without any psychological damage. By tying your stop loss to the logic of your trade thesis, you transform it from an arbitrary pain point into a critical component of your analytical process. The question is no longer, where do I put my stop? The question becomes, at what point is my original idea proven wrong? With this philosophical foundation in place, we can now explore the 3 professional methodologies for placing a stop loss. While the 1% rule dictates how much capital you can risk, these methods dictate where on the chart that risk is defined. The first and most widely used method is the structure-based stop. This is the one we just described. It involves placing your stop loss on the other side of a significant technical feature on the chart. If you are buying a stock, you might place your stop just below a recent swing low, a key support level, a major moving average, or the low of a bullish candlestick pattern. If you are shorting a stock, you would place it just above a recent swing high, a key resistance level, or a major trend line. The beauty of a structure-based stop is that it is directly tied to the story of the chart. It gives your trade a logical reason to exist and a logical point of failure. The market itself is telling you where the most recent battle between buyers and sellers was won or lost, and you are using that information to define your risk. The main advantage is its objectivity and relevance to price action. The potential disadvantage is that in very volatile markets, these obvious structural points can sometimes be targeted by algorithms in what's known as a stop run. where price briefly pokes through the level to trigger orders before reversing. The second professional method is the volatility-based stop. This approach recognizes that different markets, and even the same market at different times, exhibit different levels of volatility, or noise. A stock that typically moves $5 a day requires a wider stop loss than a stock that typically moves only $1 a day. Placing a tight, structure-based stop on a highly volatile asset is a recipe for getting shaken out of a good trade by random noise. To solve this, professionals use a tool called the Average True Range, or ATR. The ATR is an indicator that measures the average daily trading range of an asset over a specific period, typically 14 days. It gives you an objective measure of that asset's recent volatility. A trader using a volatility-based stop might decide to place their stop loss at a distance of 2 times the ATR from their entry price. For example, if a stock's ATR is $2, they would place their stop $4 away from their entry. The great advantage of this method is that it adapts to the current character of the market. It automatically gives your trades more room to breathe in volatile conditions and tightens your risk in quiet conditions. It is a dynamic and intelligent way to manage risk, though it is less tied to the specific price structure of your trade thesis. The third method, which is generally less favored by technical traders but can be useful for certain strategies, is the percentage-based stop. This is simply placing your stop loss at a fixed percentage away from your entry price, for example, 5% or 10%. While simple to calculate, this is often the crudest of the 3 methods. A 10% drop in a highly volatile small-cap stock might be meaningless daily noise, while a 10% drop in a stable blue-chip utility stock would be a catastrophic thesis-invalidating event. It fails to account for the unique volatility and structure of the asset you are trading. However, for very long-term position traders or investors who are less concerned with short-term price fluctuations, it can serve as a simple, ultimate disaster stop to protect against a fundamental breakdown in a company. Ultimately, the specific method you choose should align with your trading style and strategy. A short-term day trader might rely heavily on structure-based stops. A longer-term trend follower might favor a volatility-based ATR stop. The crucial takeaway is that your stop-loss placement must be a logical, systematic, and predefined process, not an emotional, in-the-moment guess. It must be the physical manifestation of your trade's invalidation point. When you learn to see your stop-loss not as a failure mechanism, but as an information filter, you remove its emotional power. It becomes just another tool in your professional toolkit, the clean, sharp scalpel that allows you to surgically remove losing ideas from your portfolio with minimal damage, preserving your precious capital and psychological well-being for the high-quality opportunities that are yet to come. Chapter 5: The Engine of Profit Professional Position Sizing. We have reached the practical apex of our masterclass in risk. This is the chapter where the abstract concepts of percentages and probabilities are forged into the concrete action of placing an order. This is where the rubber truly meets the road. We are going to discuss the single most important mechanical skill in a trader's arsenal, a skill that is shockingly, almost criminally, ignored by the vast majority of market participants: professional position sizing. If the 1% rule is the law and the stop loss is the line on the chart, then position sizing is the engine that connects the two. It is the mathematical formula that tells you exactly how many shares, contracts, or units of an asset to trade to ensure that you are honoring your risk management rules with absolute precision on every single trade. Mastering this skill is what separates the professional who has consistent, repeatable, and scalable results from the amateur whose trading performance is a chaotic, random mess. The amateur's approach to position sizing is almost always based on emotion, guesswork, or a deeply flawed methodology. Let's examine the most common amateur mistake, the fixed share model. The amateur decides, based on a vague feeling or a desire for a certain level of profit, that they will always trade, for example, 100 shares of any stock they like. On the surface, this might seem consistent. But in reality, it creates a wildly inconsistent and dangerous level of risk exposure. Let's say our amateur, with their 100-share rule, first decides to buy a $10 stock. Their total position value is $1,000. Then they decide to buy a $200 stock. Their position value is now $20,000. Without even considering the stop loss yet, it's obvious that their risk exposure is completely different and arbitrary on these two trades. Now let's add a stop loss. On the $10 stock, they place a stop loss $1 away. If they are stopped out, they lose $100. That's $1 multiplied by 100 shares. On the $200 stock, which is more volatile, they place a stop $10 away. If they are stopped out on this trade, they lose $1,000. That's $10 multiplied by 100 shares. Do you see the problem? Even though they traded the same number of shares, the actual dollar risk on the second trade was 10 times greater than on the first. Their risk is completely random, dictated by the price of the stock and a randomly chosen stop-loss distance, rather than by a deliberate professional decision. This is not a business, this is pure gambling. Now let's contrast this with the professional's approach, the fixed risk model. The professional trader does not care about how many shares they are trading. The number of shares is an output, not an input. The only thing they care about is that the total dollar amount they lose if their stop-loss is hit is exactly 1%, or their chosen fixed risk, of their account equity. The position size is therefore a dynamic variable that changes with every single trade based on the trade's specific parameters. It is calculated to ensure the risk remains constant. This is the holy grail formula for professional position sizing. It has 3 variables. Number 1, max risk per trade expressed in dollars. This is determined by the 1% rule. For a $10,000 account, this is $100. Number 2, trade risk, expressed in dollars per share. This is the distance between your planned entry price and your planned stop-loss price. Number 3, position size, which is the number of shares you need to calculate. The formula is elegantly simple. The position size equals the max risk per trade divided by the trade risk per share. Let's walk through a concrete step-by-step example. Imagine we have a trader named Sarah. Sarah is a professional. She has a $10,000 trading account. She has an unbreakable rule to risk exactly 1% of her capital on any trade. Therefore, her max risk per trade is $100. Sarah sees a setup she likes in Apple stock. Based on her analysis, she decides she wants to buy Apple if it breaks above $175. She analyzes the chart structure and determines that her logical invalidation point, her stop loss, should be at $173. Now she has all the variables she needs to calculate her position size professionally. First, she calculates her trade risk per share. This is her entry price minus her stop-loss price. $175 minus $173 equals $2. Her risk on this specific trade idea is $2 per share. Now she plugs her numbers into the formula. The position size equals $100 divided by $2 per share. The result is 50 shares. Sarah now knows the exact professional position size for this trade. If she buys 50 shares of Apple at $175, and the trade moves against her and hits her stop loss at $173, she will lose exactly $2 per share on 50 shares, for a total loss of exactly $100. She has perfectly honored her 1% rule. Now let's say on the very next trade, Sarah sees a setup in a different stock, say a more volatile tech stock trading at $300. She wants to buy it at $300, but because this stock has a wider daily range, her logical structure-based stop-loss needs to be placed $10 away at $290. Her trade risk per share on this new trade is $10. She runs the formula again. Her max risk per trade is still $100. The position size equals $100 divided by $10 per share. The result is 10 shares. On this trade, she will only buy 10 shares. If she is stopped out, she will lose $10 per share on 10 shares for a total loss of exactly $100. This is the beauty and the genius of the fixed risk model. On the first trade, she bought 50 shares. On the second, she bought only 10. The number of shares was completely different, but the actual risk she took, the only thing that truly matters, was identical. Her risk is now a constant, a controlled variable in her business, not a random emotional number. This methodology is the engine that makes a professional trading business run. It is the crucial mechanical link between your high-level risk policy and your on-the-ground execution. It ensures that your P and L curve is a true reflection of your system's edge, not a reflection of a few lucky oversized bets. It allows you to trade a $10 stock and a $500 stock with the exact same level of risk. It gives you the confidence to pull the trigger on any trade that fits your plan, because you know with absolute mathematical certainty that the outcome of that single trade will be emotionally and financially insignificant. Learning to stop thinking in terms of how many shares should I buy, and start thinking in terms of what is the correct position size to honor my 1% risk, is the moment you graduate from being an amateur who plays the market to a professional who runs a trading business. Chapter 6: The Asymmetry Mindset, Hunting for Antelopes. We have spent the last several chapters constructing the impregnable fortress of risk management. We have laid the cornerstone of the 1% rule, we have understood the mathematical trinity of expectancy, we have learned the art of placing a logical stop-loss, and we have mastered the mechanical engine of position sizing. A trader who diligently applies these rules has already joined the top 10% of market participants. They have guaranteed their survival, and with a system that has a positive expectancy, they will be profitable. But there is another level. There is a mindset that separates the consistently profitable trader from the legendary trader. It is a philosophical shift that transforms risk management from a purely defensive shield into an opportunistic, offensive weapon. This is the asymmetry mindset. The concept of asymmetry in trading was famously championed by the legendary hedge fund manager Paul Tudor Jones, one of the greatest traders of all time. He is known for a simple mantra that he keeps on his office wall: losers average losers. But his trading philosophy goes much deeper than that. He is said to focus relentlessly on finding trades where the potential reward is massively, disproportionately larger than the risk. He's not interested in trades where he can make 2 or 3 times his risk. He is hunting for the trades where he can make 5, 10, or even 20 times his risk. This is the pursuit of positive asymmetry. An asymmetric bet is one where the upside potential is many orders of magnitude greater than the downside risk. Let's use a powerful analogy to understand this. Imagine a lion hunting on the savannah. The lion has a finite amount of energy to expend each day. It could spend its day chasing mice. A mouse is easy to catch, a high win rate, but it provides very little energy, a low reward. The lion would have to catch dozens and dozens of mice just to survive, a very inefficient process. Alternatively, the lion could conserve its energy, patiently hiding in the tall grass, waiting and watching for a large antelope to wander by. The antelope is much harder to catch, a lower win rate. The lion might stalk and fail multiple times, but the payoff from catching one single antelope provides enough energy for a week. The reward is asymmetric to the effort and risk involved. The average trader, even one with good risk management, often spends their career chasing mice. They diligently risk 1% to make 2 or 3%. They execute a 1 to 2 or 1 to 3 risk-to-reward strategy. This can be profitable, absolutely, but it is a grind. It requires a reasonably high win rate and constant execution. The elite trader, the one with the asymmetry mindset, thinks like the lion. They understand that the vast majority of time, the market offers no truly exceptional opportunities. It offers a lot of mice. So they do the hardest thing in trading: they sit and do nothing. They conserve their capital and their mental energy. They are not interested in the small, obvious moves. They are patiently scanning the horizon, waiting for that one rare perfect setup, the antelope, where the conditions align for a truly outsized asymmetric payoff. What does an asymmetric trade look like? It often appears at moments of extreme market sentiment. It might be shorting a euphoric bubble stock where the downside, a return to historical norms, is vast, and the upside, the bubble continuing to inflate, is relatively limited and can be tightly controlled with a stop-loss. Conversely, it might be buying a high-quality asset during a moment of mass panic and capitulation, where the price has been so beaten down by indiscriminate selling that the potential upside, a return to fair value, is enormous, while the downside, further panic, is still manageable. It's about finding situations where the market's emotional, System 1 thinking has created a massive dislocation between price and value. This mindset completely changes your relationship with the market. When you are hunting for 1 to 2 risk-reward trades, you feel a constant pressure to be active, to find setups, to make something happen. But when you adopt the asymmetry mindset, you accept that your job is mostly to wait. Patience becomes your greatest weapon. You might go days or even weeks without placing a single trade. This is anathema to the amateur who feels they need to be trading constantly to be a real trader. But the professional understands that their P&L is not determined by the quantity of their trades, but by the quality of them. This approach also has profound psychological benefits. When you are hunting for a 5 to 1 or 10 to 1 opportunity, your win rate can be astonishingly low, and you can still be wildly profitable. Let's do the math. If you are exclusively looking for trades where your average reward is 10 times your risk, you only need to be right more than 10% of the time to be profitable. This means you can be wrong on 9 out of 10 trades and still make money. This reality is incredibly liberating. It frees you from the psychological need to be right. Each small loss is completely meaningless, a tiny cost paid for a lottery ticket with a massive potential jackpot. It allows you to take risks on contrarian ideas, to go against the herd, because you know that even if you are wrong many times, the one time you are right will be a grand slam home run. Developing this mindset is the final stage in the evolution of a risk manager. It requires you to move beyond the mechanical application of the 1% rule and the position sizing formula. It requires you to cultivate a deep sense of market awareness and, most importantly, an ironclad discipline of patience. You must learn to be comfortable with boredom. You must derive your satisfaction not from the thrill of constant action, but from the quiet confidence of a predator waiting for the perfect moment to strike. You must build a watch list of potential antelope setups and have the discipline to not get distracted by the mice scurrying at your feet. This is the pinnacle of defensive trading. You are so confident in your fortress walls, your 1% rule, that you can afford to patiently wait for the highest probability, highest reward opportunities, knowing that a series of small, affordable losses are utterly inconsequential in your long-term quest for truly exceptional gains. Chapter 7: Building Your Risk Dashboard. We have now journeyed through the entire strategic landscape of professional risk management. We began our expedition with the profound philosophical shift to a defensive-first mindset. We laid the unbreakable cornerstone of the 1% rule, the bedrock of our survival. We have reverse-engineered the mathematical trinity of expectancy, the engine of our profitability. We have learned the nuanced art of placing a logical, thesis-driven stop-loss, and we have mastered the mechanical precision of professional position sizing. We have even elevated our thinking to the patient, predatory pursuit of asymmetric opportunities. Now, in our final practical chapter, we must take all of this powerful theory, all of this hard-won philosophy, and forge it into a single, tangible, and indispensable tool. We must build the final and most crucial operational component of your trading fortress, your personal pre-flight risk dashboard. Consider for a moment the world of professional aviation, a field where the stakes are, quite literally, life and death. Before a pilot ever dreams of pushing the throttle forward for takeoff, they engage in a ritual that is as sacred as it is mandatory. They go through a physical, methodical, and non-negotiable pre-flight checklist. They don't just glance at the fuel gauge, they verify the exact fuel quantity for the planned journey. They don't just trust that the controls are working, they physically move the ailerons, the rudder, the elevators, and confirm their response. They check the hydraulic systems, the electrical buses, the navigation equipment, the emergency gear. Every single item on that list must be meticulously checked and verbally verified before the aircraft is deemed airworthy. This rigorous process is not a sign of weakness, inexperience, or a lack of skill. It is the absolute hallmark of an elite professional operating in a high-stakes, unforgiving environment. It is a system designed with the wisdom of 1,000 past failures to eliminate unforced errors, to catch small, insidious problems before they can cascade into catastrophic failures, and to ensure peak cognitive performance under extreme pressure. As a trader, you are the pilot of your capital. The market is an environment far more chaotic, unpredictable, and psychologically treacherous than the open sky. Therefore, the idea that you can operate without your own rigorous pre-trade checklist is an act of pure, unadulterated hubris. Your risk dashboard is that checklist. It is a simple but powerful tool, a physical piece of paper, a digital note, or a spreadsheet that you will methodically complete before you are ever permitted to click the buy or sell button. It is the final, formidable gatekeeper that stands between a fleeting, emotional trade idea and a live position with real money at risk. Its entire purpose is to force a deliberate pause, a cooling-off period that intentionally disengages your fast, impulsive, and error-prone System 1 and fully engages your slow, deliberate, and rational System 2. It ensures that every trade you take is the result of a rigorous, professional, and risk-aware process, not a reaction to a feeling. Let's build this dashboard together now, pillar by pillar, question by question. Part 1: Thesis and Invalidation. Why this trade? This first section of your dashboard forces you to articulate your idea with crystal clarity before risking a single dollar. It moves your thesis from a vague feeling to a concrete, testable hypothesis. Question 1: What is my specific, objective, and system-based thesis for this trade? This must be answered in 1 or 2 clear sentences, referencing your written trading plan. For example, thesis. According to rule set B of my plan, stock XYZ, which is in a confirmed weekly uptrend, has pulled back for 5 days to its 20-day exponential moving average. The daily chart has now printed a bullish engulfing candle, signaling a potential resumption of the primary trend. This detailed, rule-based reasoning prevents you from entering trades on a whim or a hot tip. Question 2. What is the specific price or event that will definitively invalidate this thesis? This is where you anchor your risk in pure logic, not emotion. For example, invalidation. A daily candle closing decisively below the low of yesterday's bullish engulfing candle at a price of $121.50. You now have a logical, structure-based, and predefined reason for your stop loss, completely detached from your P&L. Question 3. Have I actively played devil's advocate and sought out the bearish case? This is your mandatory defense against confirmation bias. It's a simple checkbox, yes or no. Checking yes confirms that you have spent at least 5 minutes actively searching for and reading counterarguments to your trade. You have considered why the sellers might be right. Only by honestly stress testing your idea can you proceed with intellectual integrity. Part 2. The mathematics of the trade. Does this bet make sense? This section is the cold, hard, quantitative heart of the dashboard. It removes all guesswork and emotion from your risk calculations and forces you to confront the mathematical reality of the position. Question 4. What are my precise entry price and stop loss price? You write down the exact numbers you defined in Part 1. Entry, $125. Stop loss, $121.50. Question 5. What is my trade risk per share? You perform the simple but crucial calculation. Entry price minus stop loss price. In our example, $125 minus $121.50 equals $3.50. Question 6. What is my current account equity and my resulting max dollar risk, the 1% rule? This is not a guess. You must look up the exact real-time value of your trading account. Let's say it's $25,212. You then calculate 1% of that number. That comes to $252.12. This is your absolute maximum permissible loss for this trade. This daily check keeps you grounded in your current financial reality, not the reality of last week or last month. Question 7. What is my correct final position size? Now you perform the key calculation from Chapter 5 using the precise numbers you've just established. Position size equals max risk per trade divided by trade risk per share. In our example, $252.12 divided by $3.50 equals 72.03. As a professional, you always round down to the nearest whole number to ensure you never, ever exceed your risk limit. Your final position size is 72 shares. Part 3. The final sanity check. Am I ready to fly? This final section is a holistic check of the environment, both external and internal. It is the last look around the cockpit before you commit to takeoff. Question 8. What is my target risk-to-reward ratio, and does it align with my system's positive expectancy? You must have a predefined profit target or a clear profit-taking strategy. Let's say your first target is $139. Your potential reward is $14 per share, 139 minus 125. Your risk is $3.50 per share. Your risk reward to the first target is 14 divided by 3.5, which equals a 1:4 ratio. You then check this against the data in your trading journal to confirm that this level of risk reward contributes positively to your system's overall mathematical expectancy. Question 9. Are there any correlated risks in my current portfolio or any major scheduled event risks? This is a crucial professional check. If you are already long on 3 other semiconductor stocks, adding a fourth one might be concentrating your risk in a single sector, effectively making one large, dangerous bet. You must also check an economic calendar. Is there a major central bank announcement or an earnings report for this specific company coming out in the next 24 hours? If so, are you prepared for the potential explosion in volatility? This question prevents you from being blindsided by foreseeable events. Question 10. What is my current emotional and physiological state? This is the final and most important check, a moment of brutal, unflinching self-assessment. Are you feeling calm, objective, patient, and well-rested? Or are you feeling rushed, anxious, angry, greedy, or like you need to make back a loss from a previous trade? Are you tired, hungry, or distracted? If you cannot honestly check the box for calm and objective, you are forbidden from taking the trade. You close the platform and walk away. This single question will save you from more disastrous, emotion-driven mistakes than any other tool in your arsenal. This 10-question risk dashboard is your covenant. It is your professional code. At first, you will fill it out manually and it will feel slow and cumbersome. That is the point. It is a deliberate speed bump for your mind. Over time, through hundreds of repetitions, the logic will become so deeply ingrained that you can run through it mentally in 30 seconds. But you must build the habit first through manual, disciplined repetition. This dashboard is the physical embodiment of a professional trading process. It is the final gleaming wall of your fortress, the final systems check of your armor. It is the ultimate tool that ensures that every single time you commit your precious capital to the battlefield of the market, you are doing so not as a hopeful gambler, but as a disciplined, calculating, and professional risk manager. Epilogue: The Freedom of the Fortress. We have come to the end of our journey together, a deep and unflinching exploration of the most critical and most neglected subject in all of trading. We began with the painful, visceral reality of a blown-up account, the silent, hollow click of a margin call that so many traders experience. We dismantled the great amateur misconception that trading is a game of offense, and we replaced it with the professional's core philosophy, that trading is, first and foremost, a game of relentless, paranoid, and brilliantly executed defense. We unveiled the simple, elegant, and powerful 1% rule as the cornerstone of this defense, the mathematical law that guarantees survival. We have built upon that foundation with the Holy Trinity of Expectancy, the art of the logical stop-loss, and the engine of professional position sizing. We have, in essence, constructed an entire, impregnable fortress of risk. The beginner trader often looks at this kind of structure, the strict rules, the checklists, the mathematical rigidity, and sees it as a prison. They believe that rules and processes will stifle their creativity, their intuition, their feel for the market. They believe that true freedom is the ability to do whatever they want, whenever they want. This is perhaps the final and most profound misunderstanding that separates the amateur from the professional. The professional understands that in any high-performance endeavor, from flying a fighter jet to performing surgery to trading the markets, the exact opposite is true. True freedom, true creativity, and peak performance do not come from a lack of rules. They are born from a foundation of unshakable structure. The fortress of risk you have just learned how to build is not a prison. It is a liberation. The 1% rule is not a restriction on your ability to make money. It is the very thing that gives you the freedom to trade without fear. When you know with absolute mathematical certainty that no single trade can ever significantly harm you, the immense psychological weight of fear is lifted from your shoulders. A logical stop-loss doesn't limit your trades. It frees you from the agonizing prison of a runaway losing position. Professional position sizing doesn't constrain you. It frees you to treat every trade with the same objective, unemotional clarity. The structure is not the enemy of creativity. It is its greatest enabler. When you no longer have to waste your precious mental energy worrying about blowing up, you free up an immense amount of cognitive bandwidth. You can then direct that energy where it truly matters, to studying the market, to refining your strategy, to patiently waiting for those perfect asymmetric opportunities. The fortress handles your survival automatically, so your conscious mind is free to think at a higher, more strategic level. This is the ultimate paradox and the final thesis of our masterclass today. The path to becoming a creative, intuitive, and profitable trader is paved with the bricks of mechanical and often boring discipline. The rules are not your cage, they are your wings. Today, we have laid the complete foundation for that fortress. This is the bedrock. And for those of you who are part of our collective study here at the Trading Thesis, you know that our goal is to build the complete professional trader piece by piece. The next logical layer to build upon this unshakable foundation is learning how to transform your biggest losses into your greatest teachers. That's why our next deep dive will be all about turning your worst trades into your greatest lessons. To ensure you're in the room with us as we lay that next critical brick in your arsenal, make sure you're subscribed with notifications turned on. It's how we continue building this together. And to that end, I want you to start building tonight. Head down to the pinned comment. I've left a prompt for you there, the very first question from the risk dashboard we built today. I want you to answer it. It's the first step in making this theory your reality. I'll see you in the comments section.